As you see here, by the way, during the session, I will try to cover all presentation and slides approximately in 45 minutes. During the session, you can directly intervene if you have any type of question. But if you also want to ask simultaneously, if you wonder any points that we cover during the presentation, you can directly intervene and ask by taking the microphone. If you couldn't have, you can write your question in the chat side, and I will simultaneously try to answer all those questions as well. But today, as I said, in approximately 40-45 minutes, I'm trying to cover all the slides and presentation. And in the last 10 or 15 minutes, I will give the microphone to all participants and we'll take your questions and make a brainstorming session. So let me start with global macro outlook for the 2024 expectation and challenges, part 2 right now. As you see in the macro outlook 2024, exhibit 12 showing us that we forecast above consensus GDP growth in 2024. So as you see here, the consensus for the 2023, and we are in the last days of the years, this is generally the Goldman Sachs expectation, and the consensus all around the world for the US GDP growth is around just 2.3%, but the Goldman Sachs expecting 2.4%. But the next year, as you see here, we will try to cover this part. As you see here, the consensus all around the world, the average expectation for the GDP growth. May I request something from the participant? Please don't move your mouse. Please don't touch your mouse. Just follow the presentation. As you see on the screen, if you move your mouse, you blurred the presentation and I couldn't read. Could you try to don't move your mouse? I will reflect the presentation once more, but please during the presentation, don't touch the screen and the slides. As you see here, the global consensus for 2024 is just 1%, but the Goldman Sachs expecting approximately 2.1% GDP growth in the United States. And Euro area, however, is just 0.7% because the last economists and investment banking sector and all macro management investment firms expecting a recessionary process in Euro area, and the growth will be around just 0.7%, but Goldman Sachs expectation is a little bit above that, 0.9%. And with the differentiation of the economies, Spain is positively diverged and France is positively diverged, but the slowest one is Germany, which is the motor dynamics of the GDP growth in Euro area as well. And the Japan, just 1%, but here, as you see in the Goldman Sachs expectation is 1.5%. And the UK is 0.5%, because lots of economists, as I said, also expecting a recessionary process in United Kingdom. And United Kingdom last growth process in 2023 as well, in the third quarter and last quarter, will be in recessionary period as well. It is contracting. And Canada and Australia is 1.1 and 1.8, but the consensus is really below that. For the Canada, it is 0.6, and for the Australia, it's 1.5. The most dramatic economy is China. As you see here, China GDP growth expectation is 4.5, but the Goldman Sachs expecting 4.8. And China is the motor dynamics, growth dynamics of all over the world. So just with Chinese growth 4.8, it will a little bit increase the world average more than approximately 5 economies. Let's say Europe, Germany, France, and Italy total growth and total contribution to global economy is less than the Chinese contribution. For that reason, how much the China is growing will be one of the best indicators how much the world will be grow in the 2024. And the world expectation, as you see here, 2.1, and the Goldman Sachs expectation is 2.6. We can say here, if the world average growth is 2.1, most of the developed market economies, except if we make the China and India out of the circle, all the developed market economies will growing process will be less than the world average. So developed market economies will be a slowing and soft landing process during the 2024. As you see here in the explanation, more broadly, we expect another year of growth outperformance across most of the economies we cover. We forecast 2.6 global growth in 2024 on an annual average growth rate, a touch above our estimate of global potential growth. Most notably, our forecast call for US growth to again outpace its developed market peers, with country-level forecast implying 1.1 point in percentage outperformance in the US, and the Japan 0.5, and 0.5 in Canada, 0.3 in China, 0.3 in Australia, and 0.2 in the Euro area. So Goldman Sachs expectation is a little bit higher than other investment banking and macro management firms' expectation for the global market dynamics and the growing process. And the first reason is our constructive outlook for real disposable income growth in an environment of much lower headline in inflation and still strong labor market. As you see here, the Exhibit 13 showing the continued real income strength in the United States and pickup in Europe. So you can see the countries here. The blue one is the US, and the red one is Euro area, gray in the UK, and the green is the Australia. And the real income is still strong. What we mean by this? With the labor market strong outcome and outlook, and the headline inflation is still higher than expectation, and the Reserve Bank target rates, all central bank target rates, is still below the current inflation rate. For that reason, the real income strength is still above the expectation. So, although we expect US real income growth to slow from the outsized 4% pace seen in 2023 to approximately 3.75 in 2024, this should still be sufficient to support consumption and the GDP growth of at least 2%, meaning that the consumption-driven growth will be still in the United States. So the inflation can be a little bit stationary, but still above the expectation and the target rate of the Federal Reserve Bank. And this will be triggered by the consumption level of the United States. And meanwhile, both the Euro area and the United Kingdom should see a meaningful acceleration in real income growth to around 2% by end of 2024, as the Russian gas shock fades. And here, as you see in the top of the dashed line, this will be showing our financial condition, monetary and fiscal policy on the developed market economies. On the left-hand side, this will be showing a GDP growth according to financial condition, the dark blue, and the light blue is the fiscal policy. How much it is contractionary, how much it is expansionary. As you see here, look at the financial condition and the fiscal policy condition for the developed market economies. Really contracting. And we estimate here, please look at the explanation above the chart line. We estimate that fiscal policy will subtract 0.2 point in percentage from global growth in 2024, with only a slightly larger 0.3 drag in developed market economies. The drag is likely to be small in the US because the most pandemic-related stimulus has already ended. please keep in mind that during the pandemic, during the COVID crisis, we have lots of fiscal stimulus, right? Lots of central banks, lots of governments even sent the direct cash check to their citizen. In the United States, approximately half of the citizens take from the Federal Reserve government $1,000 cash check. This is a fiscal stimulus because United States understand that lots of the people who are living less than the average living condition needs a little bit stimulus money to be alive, right? To be alive, because lots of people couldn't go out from their house as well during the COVID crisis. So to be alive, you need a little bit sustainable level of money. And during this time, the government pay lots of cash for these citizens. And this should be financed, right? The government cannot be give a budget deficit until forever. This budget deficit should be financed by some tax revenues in the long run, in the next generation. So this budget deficit, huge expansionary fiscal policy during the COVID crisis, now financing by the contractionary fiscal policies by increasing the tax rate in these countries, right? Because you give lots of deficit and you need additional money to pay those money to back to the government. For that reason, as you see here, US, because most pandemic-related stimulus has already ended and fiscal consolidation is unlikely to start in a presidential election year. It should be larger in the UK and in the Southern Europe. Our combined monetary and fiscal impulse estimate is set to fade despite modest fiscal headwinds, however, and points to a maximum pain point in late 2022. Please look at on the left-hand side first. Please try to understand this chart first. And then please look at the chart in the right-hand side. You will understand what I mean by this. As you see here on the left-hand side, developed market composite index in the financial condition, especially until the end of COVID crisis, it will be expansionary, as you see here, right? Because lots of government giving the fiscal stimulus here. But after the COVID crisis, to finance those expansionary policies, we should make a contractionary fiscal and monetary policy to finance all those conditions. So today, as we understand, we should directly do these type of contractionary fiscal and monetary policies to finance all those stimulus during the COVID crisis. And on the right-hand side, major developed market economies' financial condition, when we make the separation by the countries, Japan, US, Canada, Australia, Euro area, UK, and the developed market average, as you see, financial condition is really contractionary in United Kingdom. And a little bit less than that, but still above the average, contractionary in Euro area. Australia is almost same with the average, as you see, Australia is here and average is here. And the Canada and the United States contractionary, but less than the developed market average. But the Japan is still following a expansionary fiscal and monetary policy because of really low inflation in those countries. It is a structural problem for Japan. Japan is out of the case. You will see in the next slides why Japan is differentiating from the world and the developed market average in their fiscal stimulus and in their monetary policy, because they have some structural problems while creating the inflation, and they are still following expansionary monetary and fiscal policies, reversal the world average. All the developed market economies today is contractionary, increase in tax rate, increase in the interest rate, monetary policy is contracting, fiscal policy is contracting, but in Japan, the reverse. In Japan, still we have lower interest rate and lower tax rate. And here, as you see, this exhibit 15 showing us gas-intensive European manufacturing is finding a true and inventories are edging back to normal levels. Hang on a sec. Sorry for this. My little comes to me. I will bring it to here. Sorry for this. Really sorry for this disturbing issue. It was sudden. I couldn't control for that reason. In the slide, as you see here, Exhibit 15, gas-intensive European manufacturing is finding a true and inventories are edging back to normal levels. What we mean by gas-intensive manufacturing? Think this. We have lots of industries, right? Manufacturing, services, construction, textile, lots of industries, manufacturing sector. And in this type of sector, some sectors are labor intensive, some sectors are capital intensive, some sectors are gas intensive. What we mean by this? For instance, let's say we are producing a textile product, and this textile product machine is working only with gas, not the labor, but just with gas. So during the Russian crisis, if the Russian gas is cut throughout Europe, this means that this sector, this gas intensive sector, no possibility to produce more because there is no gas. And this production cannot be replaced by labor intensive production. So if you add more labor in your industry, you couldn't achieve to produce more. Because this type of production is just gas intensive, and this can be only achieved by producing and importing additional gas and working these machines just with gas. For that reason, as you see here, gas intensive industries is contracting. Non-gas intensive industries here in the red and the blue line. Gas intensive industries is still contracting, but non-gas intensive industries like services sector, like restaurants, like hotels, these are non-gas intensive industries and they are still expansionary. But the gas intensive industries are still contracting and will be contracted during 2024 as well. And on the right hand side, if we look at the inventory to GDP ratios, meaning that if you have inventory in your stocks, meaning stock is inventory, if you have inventory in your stocks and if this GDP ratio, inventory GDP ratio is high, this meaning that you are importing some products, but you are not using these type of products to produce more outcome, because we have intermediary goods, right? Inputs and outputs. We are importing something and we are using these imports to produce an export and output, right? Another last product. But if this stocks is increasing, meaning that you are not using these type of imports, goods and services to produce more. So your growth will be decreasing. If inventory to GDP ratio is increasing, your growth will be decreased because you are not using your capacity to produce more. You are just collecting them as inventory. So as you see here, the 2024 is a little bit really low growth rate because inventory to GDP ratio is increasing. But for instance, in Taiwan and South Korea, it is more than expecting. It is more than the average. So their GDP growth is more than less than the world. And here in 2024, please look at the year, GDP and inventory ratio is decreasing, meaning that inventories will be used to produce more GDP, more output. So this will trigger our output, GDP growth, economic well-being, and the welfare of the economies. Please look at and try to understand this chart in the exhibit 16. These are the central banks are more willing to pursue insurance costs as inflation cools. What we mean by here, central banks are more willing to pursue insurance costs as inflation cools. Try to understand this explanation on the chart. The final and the most novel reason for optimism on growth is that because the central banks don't need a recession to bring inflation down, they will try hard to avoid one. Several of the emerging market economies, early hikers, because please remember the previous class, we have developed market economies and we have emerging market economies. Developed market economies is G7, US, Japan, United Kingdom, Germany, France, Italy, Australia, and Canada. These are the developed market economies. And we have emerging market economies on the left-hand side, like the Latin American countries, Brazil, Chile, Colombia, like the Eastern Europe, like the Romania, Poland, Bulgaria, and Hungary, Turkey, Russia, India, and China, or South Korea. These are the emerging market economies. As we know that risks in the emerging market economies higher than the developed market economies, they are early hikers in interest rate because their inflation is really high. For that reason, they started the interest rate increasing process earlier than the developed market economies. Several of the emerging market early hikers, including Brazil and Poland, have already begun to cut policy rates from highly restrictive levels and are likely to deliver ongoing steady cuts. We see less scope of preemptive easing in the emerging developed market economies, but think developed market central bank would lose little time before pivoting the cuts if the growth looks deteriorating meaningfully, meaning that if the growth expectation is going down higher than expectation, these central banks will a little bit cool the interest rate cut process, right? Indeed, our analysis of past hiking cycles confirms that major central banks are twice as likely to cut rates in response to downside growth. So if the growth rate meaning that expectation in recession is a little bit higher than the average today, or today average level, we will see more rate cut in the interest rate. Today, I could reflect the market interest rate probability of the United States, how it changed from the January or July to the December, because we all know that the contractionary policies during the 2022 and 2023, during these 2 years, increase in interest rate to bring down the inflation, really start a recessionary expectation in the market. And the United States stopped at 5.5% in the interest rate. And today, market is pricing 3 rate cut during the 2023 and 2024. What we mean by this? If the growth rate expectation is still going down in the United States, the United States Federal Reserve can even cut the interest rate 5 times in a year, meaning cooling the economy to 3% interest rate. Today it is 5.5. And here, as you see, across the developed market economies, central banks, please try to understand the exhibit here. Cuts are coming sooner. Here, these are all cuts in the interest rate. And these are the countries. The blue is Brazil, red Chile, gray Mexico. The light blue is Hungary, green is Poland, and the light green is Czech Republic. These are the emerging market economies. And today, we are here in the interest rate. And the next couple of years, we will be here in the interest rate. Why? What is the reason? And please try to look at understand this chart as well. Left-hand side is emerging market, and the right-hand side is the developed market economies. Today we are here in the developed market economies interest rate, and the developed market economies here, blue is US, red is Euro area, gray is United Kingdom, light blue is Canada, and the green is Australia. Today, the most of the central banks' interest rate is around 5%. But in the next couple of years, all central banks will cut their interest rate approximately to 3%. And for the emerging market economies, as you see, even some of them is funding the market with policy rate above the 14% as well. But their interest rate will go down approximately to 8% in just 2 years. What will be the basic reason behind the screen? What is the main dynamics to bring down this interest rate? Sorry for this, just one second. As I said on the left-hand side, as we see in the emerging market economies, approximately 14% of the policy rate, and on the right-hand side, major developed market economies, today approximately 5% policy rate. The developed market economies will cut their policy rate from 5% to 3% in 2 years, and the emerging market is approximately from 12 and to 13% to the just 8%. The basic dynamic behind this screen is this. When you increase the interest rate, the inflation will go down gradually because you are decreasing the demand. If the cost of the money in interest rate is high, the consumption, investment, all these type of decision is postponed. Lots of decision maker. For instance, you are investor, and if you borrow the money with 15% from the market, you will not make investment. If investment decrease, if you borrow money from the bank to make a quote or to buy a car, if the interest rate is 15%, you will not buy that car. You will not consume. Investment go down, consumption go down, and inflation go down gradually. And with this interest rate, inflation will go down. But the main problem is market and growth also will go down. So the central banks, to make a stationary process for the growth and to bring the growth rate with the potential and expectation, combine and collaborative with the economic potential, they will decrease the interest rate gradually to also support the real market indicators production level as well. This will happen both in the developed market economies and emerging market economies at the same time. And as you see here, please try to understand here on the left-hand side and the right-hand side, we have two different charts. Elevated deficits and the widespread adoption of the generative artificial intelligence should support a higher than the long-term rates. Here we have estimated change in government balance as a share of GDP, meaning that what is the budget deficit in these countries? And here, the GDP growth, how this can be offset by the budget deficit. Please look at the left-hand side, the emerging market economies here, and the global, please look at the countries here, Russia, Germany, United States, Italy, France, India, and the global here, the China, UK, Canada, Japan, Spain, Australia, and Brazil. And the global is gray, global average. The light blue is emerging market average, and the dark blue is the developed market average here. What we mean by here? For instance, why the Russian budget deficit is 5%? and really higher than the emerging market average. What is the basic reason? Because they are in war. They are supporting the war, and they are giving lots of investment. They are consuming lots of money from the government budget to finance the war expansion, right? All war expense is financed by the government budget, and the budget deficit is increasing in Russia. And which one is the lowest budget deficit is Australia, and the Brazil is just around 0.5%. And here, as you see, this budget deficit, because you are increasing really consumption, this budget deficit is really triggering the economic growth, GDP growth, gross domestic product growth. This is just an artificial intelligence perception and the reflection for the GDP growth rate. As you see here, this will be better in Australia, Japan, Canada, and the US. And here we are. We are in what we said a few minutes ago about Japan. We say that Japan is out of the case in developed market economies. And this picture and this slide trying to explain why Japan is out of the case and how it is differentiated from the developed market economies in their monetary and fiscal policy. Please look at the chart in Exhibit 19. Chinese inflation may fall back to the target, but the Bank of Japan eye are on the shanty. Please try to understand this chart. In this chart, we are trying to show the different subsectors of the inflation. The dark blue is headline. The light blue is the new core inflation. The gray is Western core. And the red one is core services inflation in Japan. And even in any case, Japan inflation will just converge to the 4% despite lots of expansionary fiscal and monetary policy. Today, all central banks contracting their monetary and fiscal policy, increasing the interest rate, increasing the tax rate, they are all contracting market. But the Japan is on the other side. Japan is decreasing the interest rate. Japan is decreasing the tax rate. Japan giving lots of fiscal stimulus to the market. But despite all this stimulus, the inflation rate is still just the Bank of Japan target level. And as of 2024, the inflation rate will go down gradually to the Bank of Japan inflation target rate. And here is the explanation for this. Among the developed market economies, Japan stands apart because the inflation pickup was largely desired. They are trying to inflation high because it is really low. After 3 decades of anemic price pressure or outright deflation, because Japan is in deflation process, the strong 2023 Shunto wage round signaled that Bank of Japan was moving towards the goal of establishing a virtuous cycle between wage and the prices. Please keep in mind that if you increase the wage, this will gradually put a pressure on prices as well, right? Because if you increase the growth rate of the wage in the market, if I have more money than I have yesterday, this means that I can consume more, and this will trigger the inflation and consumption. And there is a vicious circle between wage and the prices here. For that reason, healing global supply chains imply that some moderation in Japanese inflation, which all by measures is currently above 2%, is likely in the pipeline, but underlying services inflation is likely to remain firm against a stronger labor market. And on the right-hand side, please look at the Exhibit 19 right-hand side. This one, base pay rise, meaning wage growth from the here. And look at this one. Huge increase in wage growth. base pay, right? And the Bank of Japan is with the Shunto wage growth. They are trying to increase the inflation by increasing the wage growth as well. They are giving huge stimulus to disposable income side of the citizen and countryside households, and people are trying to consume more than expecting and triggering the consumption-driven inflation. And now the case is China, because Japan and China, the Asian tigers on that side, is really diverging from the world average. One of them in emerging market economies and one of them in developed market economies. Japan is diverging from the average of the developed market economies, and China is diverging from the average of the emerging market economies. Temporary relief from Chinese multi-year slowdown. Please try to understand this explanation. China's reopening rebound in 2023 proved somewhat disappointing because China is not reopened fully during the 2023. And its multi-year property slowdown has continued a bit in 2023. There is a problem in China real estate and property markets. And all the world is following and monitoring what is happening in China property market, because they are afraid this type of problem, especially in mortgage and property market, can widespread easily from China to the rest of the world. So lots of the market and the market makers are prudential about these indicators. Still, growth in China has picked up modestly in recent months and should benefit from the further policy stimulus in the near term. We expect China's GDP growth to slow down 4.8 in 2024 as the easy gains from reopening fade into the rear view, but is supported by a slightly smaller housing run, because the problem in housing market, real estate market, is still there. For that reason, despite the China reopen and converge their growth rate to their really potential growth rate, housing market is still bringing down some of the indicators, and a modest rebound in global trade and additional policy easing that should be front-loaded in half first in 2024. And here, as you see, this is contribution to the China real GDP growth, no COVID rebound, the red one, the smaller property, this is 0.4, net export is still alive, increased policy support because China, People Bank of China and the Chinese government, communist government, giving lots of stimulus to support the policy in the China. And the 2024 forecast is approximately here, 4.8. And on the right-hand side, the China effect of financial condition on real GDP growth, as you see, it will be here. Okay. Please try to understand, these are the quarters, by the way. The first quarter of the 2024 will be the highest in GDP growth, but the rest of the year will be half of it, but still alive. There is no recession in China. And here we are trying to analyze the Chinese property market and the housing sector. What is happening there? Please look at the chart and try to understand the explanation here. This chart showing us that this blue line showing how much housing new start in China and how much of them are new sales. Okay, this red line. As you see here, from 2000 till the COVID crisis, there is an upward trend, right? Always increasing in new starts in China's housing market, and new sales also increasing. So they are building up new houses, and almost all of them is sold to the household or rest of the world. This is a good trend because there is no inventory. You are building and they are sold. But during the COVID crisis, as you see here, there is a sharp decline, sharp contraction in new housing stock and new sales. And from there, gradually and continuously, the new housing start in China is going down, and new sales also going down. And this is a really problem in Chinese housing market, because the level here, new housing start and new sales in housing market, is just around approximately 15 years ago's level. Okay, China paving the way in their growth and investment side, but housing market bring down their old investment and decision-making process to the 15 years ago level. As you see here, if this China housing market does not have a reconciliation process, this will still be a really big and a risk problem for the rest of the world, especially for the housing and mortgaging market. And here we are trying to show the China real GDP growth forecast. We are here in the 2023, and we are trying to make a forward forecast for approximately 10 years. And during the 10 years, the Goldman Sachs saying that China's growth rate will slow down approximately 3.5% on average after 10 years. But normally, as you see here, between 2015 and 2019, China growth is approximately 6.7, meaning that in 10 years, China will cool down their economic indicators and their GDP growth will be less than last 5 years average, half of it, because it's approximately 6.7, and in the 2030s, we will have just 3.5% of GDP growth in China. So we now understand that China economy is cooling down and a rebound process. They go down, they increase their GDP growth really high in 2010. During 5 years, approximately 7% GDP growth. This is a huge GDP growth for any type of economy, even emerging, even developed market. 7% is really high. Then, from this increase in GDP growth, Chinese economic indicators, economic potential, investment, consumption, and housing market is cooling down and bring down their economic and sentiment of the real market approximately to 3%. And here we are trying to calculate the probability of the weighted Fed fund rate forecast in next couple of years. As you see here, the Fed fund rate in blue line, okay, this is the blue line Fed fund rate. This is 5.5% today. And if there is a recession, in the market, the interest rate will follow this path, the gray line, and it will decrease approximately 2%. Because if there is a recession, nobody wants to buy, nobody wants to consume, inflation go down, growth go down. So government needs a new stimulus, needs support for the economy to bring the inflation and the economic growth to the average path. So they will increase their rate cut process in a recessionary period. But if the growth scares, no recession, but growth slow down, the interest rate will follow this light blue path, and it will be approximately in 1 year around 4%. So approximately in each monetary policy meeting, approximately we will have 5 rate cuts. And if there is inflation higher than longer in the market and there is no recession, this means that the red line will be our new base case for the interest rate, and it will follow this path, meaning that interest rate will increase to the 6% and will gradually follow that path approximately during 1 year. No rate cut and no rate increase. And the Goldman Sachs make another path. As you see, this is market pricing, this red line. The dash line of the blue is the probability weighted average path of the Goldman Sachs. And the baseline the base scenario is the normal blue line for the Goldman Sachs expectation for the rate cut or rate hike process. And this is the last slide. What we expect for the 2024 in our investment return. And the title for the chart is we expect higher return on non-cash asset than cash. Today, if I have cash, interest rate is 5.5%. High, really high. Higher than the 20 years average. But we all expecting today that there will be no huge recessionary process in the market. And because there is no recession, the rate cut process will follow the market indicators. Interest rate will gradually go down. Cash return will gradually go down. And the other assets return, like commodities, like equities, like credit market, like fixed income, their return will be higher than the cash return because interest rate will gradually go down during the 2024. Our baseline scenario is this. Today, cash higher return, but next year, cash will be less return than the investment, than the stocks, than the commodities, than the fixed income, or than the credit market.